such an asshole!
Continue on here at Asshole Consulting. You go to assholeconsulting.com, send me your questions, send me your money, and I will answer you. This is the second question from the same client. Can you give some details about money market funds? Is it possible to lose principal amount in them? Would you recommend folks keeping at least part of their money in them, say $10,000? Well, you can't put a nominal number on it because it depends what your overall portfolio is. So you kind of more want to be like, what percentage of your money should you have kept in a money market? Specifically, check this one out, which I did. I know you don't generally give out opinions about specific investments. I just want a general view is all. Or is it worth it, or is it too risky? And even more, will they survive another theoretical, hypothetical crash? Okay, so let's explain what money markets are. When you have a 401k, IRA, 403b, or even just a regular old stockbroker account, you have to fund it somehow. And what your broker or financial planning company will say is, all right, well, we're not. You gotta send us money, okay? And then that way you can then go buy stocks, bonds, mutual funds, whatever you want. And now we can let it sit there in cash, but cash doesn't earn interest, and so slowly but surely you'll lose your 2% a year to inflation. And so what they do instead, so you earn at least a modicum, just a little bit of interest on it, is they will throw it into a money market account. Money market accounts invest in very liquid, short-term, very low-risk investments and securities. So you're looking at your T-bills. These are government treasuries that have a maturity. They come due in less than 1 year. Presumably it's risk-free because the government could just tax the living fuck out of all of the people, and that way it's, we don't have to worry because the government would never default. The government's never defaults, and we don't have to worry about deficits, according to Paul Krugman. What else? There's CDs, just like your banks offer CDs, for that whopping 0.75% interest if you hold it there for 6 months or a year. And then commercial paper is another major one. And commercial paper is, what's that? It's other short-term lending stuff. Like if a company goes out and let's say it borrows $2 billion to buy a whole new fleet of trucks, that's not short-term and that's not low risk. The company, you're talking billions of dollars. It's a capital loan, long-term, 10-year loan, 5-year loan, stuff like that. What commercial paper is short-term, again, under a year, and they use it to finance, I hate to be so boring and accounting-like, but receivables and inventory. It's like a revolving line of credit. If you don't know what that is, it's basically, it's to finance a short-term cash shortage that they have between the operations of the firm. So let's say you are your Target Corporation, and you buy on credit, you borrow the money, a bunch of toasters, all right, and you promise to pay the toaster company within 30 to 60 days, all right, so technically he has lent you that money for the toasters. You then sell on credit these toasters to your clients, and let's say you have they don't have to pay cash, they can pay credit, and you grant them terms of 90 to 120 days. Well, now you got a shortage. Like they borrowed the money, now you got to pay them back in 30 to 60 days, but you may not be getting your money for 90 to 120 days. So this misconnection, this misalignment between accounts payables, accounts receivables, inventory financing, stuff like that. They have what's called revolving line of credits or line of credits that a company can borrow on, but then then they pledge the accounts receivables, the payments, as collateral to that. So when they get paid for accounts receivable, they then pay their creditors. So you're talking short-term financing. Usually the companies are very high quality, low risk, and you have your receivables, which are also liquid. It's very unlikely they're not going to pay you. And then they pledge those receivables, like that's what you're investing in. You're lending money to these corporations to finance their 60 to 90 day shortfalls in their receivables. So long story short, low risk. So you're making your maybe 1 or 2% rates of return. Now, let me get to I'll pull up the question again here. So that's it. So that's what. So you're just saving your interest. You're saving against inflation there. Give just general view of all. Is it worth it? Is it too risky? And even more will they survive another hypothetical crash. All right, so let's talk about the risk. They're generally considered very low risk. And commercial paper money markets have, quote, never defaulted, because the federal government has never defaulted. We've never had default. And thus, therefore, historically, there has been no risk. They're considered risk-free or very low risk. But it is still possible that you might lose money on a money market fund. And the reason why is, well, it's happened twice because of the commercial paper aspect of it. We had a great recession that happened. And when the recession started to hit and go full bore, all of a sudden, a lot of these clients could not pay. All these accounts receivables would not be able to pay off this commercial paper to the corporations that had those accounts receivables. So the federal government came in and bailed them out, or said, "No, we'll provide financing." Blah blah blah. This also happened before, of course, at about that much of a fraction of the size. It was called Penn Central, I think. It was a railroad. This was 1960s, 1970s. And what happened there is this, everyone thought there was this stable company, Penn Central, and oh my gosh, this commercial paper is as good as gold. And it wasn't. They said, we can't even make ends meet. And that sent a shockwave. People were like, oh my gosh, what about the rest of commercial paper? You know, all of a sudden you get one bad apple, you start to wonder how many of the other apples in this barrel are bad. And again, back then, the Federal Reserve came in and I think it bailed them out like it was $500 million. Some pittance of an amount compared to, not $500 billion, $500 million. Like, it's nothing. So they came in and shored it up. So are they risk-free investment? I'd say, hell yeah, they're risk-free. You want to know why? Because the Federal Reserve is going to come in and print off as much fucking money as it needs to make. They're too big to fail. That market's too vital of a market to fail. But that doesn't mean in the real world that there isn't risk. There is risk, of course, involved because, you know, even on the Treasury bills, yeah, the federal government could default on it. There's no such thing as no risk. It's very cute in finance because, well, did you do a risk-free investment? No, it's not. It is not. It is not. According to academians and Wall Street people who are constantly bailed out by the government and believe in the almighty power of government, there will become a time that even the almighty U.S. government won't be able to bail it out because no one's going to have anything to fucking do with it. And then we print off our money and it's hyperinflation, blah, blah, blah. That's a separate thing. So, sure, what percentage of people invest? It's not really, you're not investing, basically. You're not even beating inflation nowadays with most money market funds. So, it's just a place to park your money until you find some better place to invest it that you like or you trust. So, it's kind of actually really boring. Yeah, you could go ahead and throw it in there. Again, there's no guarantees. Yes, you could lose your principal. It's unlikely, but yeah, you can throw it in there. It's not investing. You're not going to make 4, 5, 6, 8, 10, 12%. It really is just keeping your powder dry until you find something down the road. Now, of course, some people say, yeah, keep a fair amount of it, say 20% in cash because wait for a stock market to crash. Then you can cash out your money markets and go buy, whatever stock it is that went on sale. What did Deutsche Bank file for bankruptcy? Maybe I'll go buy some of its penny shares before the European Central Bank bails them out. But yeah, that's it. Aside from that, yeah, there's a little bit of risk involved. It can happen, but otherwise, yeah, that's just where you keep your powder dry before you go buy on a buying spree. So there's not much there. But, that's why you have gold and silver because that's the ultimate backup against also in the treasury bills and the commercial paper market failing. So if you're really worried about hedging against hyperinflation and collapse of currency, you need precious metals. But otherwise, yeah, if you're the standard 401k IRA clergy and you just believe in that church and you bow at its altar, yeah, keep a little bit. I would say there's no rule of thumb because everybody's different, but I would keep about 10%. So you have some purchasing power, maybe 20%. Depends on what your investment goals are. It really depends on each individual. So anyway, that was the wonderful and exciting world about money market funds. I hope you guys enjoyed it. Toodles.